There's an overwhelming amount of financial advice in the news and on social media. Who do you listen to? Are they looking out for what's best for you? How do you tune out the noise? In this podcast, trusted advisors Emily Agosto, CPA, and David Vaught, JD, bring their extensive education and experience to delve into all aspects of personal finance. Emily and Amanda make topics like investing, taxes, and financial planning interesting and accessible. And they provide a framework to help you think through the plethora of financial advice and news out there. Are you ready to start making the best personal financial decisions for you? Welcome to Connecting the Dollars with Propel Financial Advisors.
Hello, Amanda and David and Danielle. We're all here together in the same room in Maryville, Tennessee today, and we thought we should record a podcast, and we want to talk about, so we've talked a lot about bonds on a few of our different podcasts, so we thought we'd jump to the other side, which are equity assets. So we're going to talk about 3 different types of equity assets that can be in your portfolio that we research and buy for you, our clients, and for ourselves.
Yeah. And I think the 3 main categories you can access equity assets is in the form of mutual funds, ETFs, or individual stocks. And so those are all, we buy all 3 for our clients. And so today is not going to be investment advice on specific assets to buy, but just an idea to give you some of our thinking around these different types of assets. So because we have David and Danielle with us today, our 2 fellow advisors, we'd like to have them do a lot of the talking today, but Emily and I will be chiming in every once in a while. And we are filming this the day after the hawkish pause. And so might discuss some of the Fed movement or non-movement as well. Fed speak. So some people are calling a hawkish skip, but I think hawkish pause sounds better.
Oh, that's my favorite. Yeah,
it's more fun.
I think it sounds like a band name.
Yeah, right. So I think first off, we'll start off with mutual funds. David, would you say that's your favorite equity asset to buy?
Well, they're very flexible. They've been around a while. They generally were begun, I think, with a lot of motivation about diversification. Instead of buying 1 or 2 or a handful of individual stocks, you could buy a larger number of stocks in mutual funds managed by a professional who would try to do better than you might do on your own. The idea worked, although they come in all shapes. They're not all fully diversified. A lot of them are concentrated on purpose because they want to take the best ideas of an active manager and put them to work. You can also buy index funds that now are often associated with ETFs in mutual funds. Many of those are very cheap, very effective at diversification. But index funds, whether they're in ETFs or mutual funds, present another problem. They seem too easy. They seem too cheap, like too good to be true. And they often skip by what I call the allocation decision. What do you really want to invest in? Do you want to just invest in big U.S. companies, or do you want to be invested in emerging markets, or do you want to be invested in smaller, faster growing companies? There are indexes that fit into all those categories, just like there are active mutual funds that fit into all those categories. And that's a really key decision, not just the device, what it's in, the mutual fund or the ETF, et cetera, but how is it allocated? And so if these things, these vehicles, I'm going to call them, these devices, become an excuse not to allocate, you got a problem.
Yeah, and I think we do hear that from prospective clients. Sometimes who come in, they hear this generic advice. Oh, I think I'm just supposed to buy an index. And then if you start digging a little deeper, it's like, which index? Why should you buy the index? Should you buy it as an ETF or a mutual fund? What do you tell clients who come in with that sort of preconceived notion, Danielle?
Well, I want to
Or you
Kinda
want
like
to take
two
a step
things.
back?
Yeah, I kind of wanted to go back to what
Okay.
David said for a second. He was talking about allocation decision, and I wanted to be clear about what that means. And he also talked about diversification, and I think that the idea of that is also very subjective. And so one thing I wanted to touch on was when he's talking about an allocation decision, he means, say you open up an account somewhere and there's 5 indexes that you want to buy. You want to have some international exposure, and you want to have some of the big companies in the United States. You have some small companies in the United States, and you've heard that real estate's a great buy, technology, or whatever it is you want to buy. But the next big decision is how much of each of those to buy, and that's what David's referencing when he's saying an allocation decision. And we don't know. So unless you buy an index that claims to cover everything, and those are out there, and I don't like those. There's really no way to make sure you're getting everything. And then that leads to the diversification discussion. I mean, is having 500 of the top US companies truly diversified if only 10 of them are 80% of that index? And then again, what is diversification? Is it 10 companies? Is it 40 companies? Is it 1,000 companies? So those are decisions that the answer to those questions, I think, are different for everybody, and some vary from I don't care, I just want to make money and I don't want to think about it. I don't get it, I want somebody to do it, or I can just buy an index and have that done for me. And back to Amanda's question, which was, what do I tell clients? I think that's what she said.
Yeah, I feel like you answered most of it.
Because what you're saying is that's not easy. And it may not be cheap in terms of your bottom line.
No, I think that's the thing, is that people think if you buy an index, it takes all of the guesswork and decision making, and if you just do that, that's all. But if that's what you do and you keep your blinders on, then sure, you've covered it. But truly, there are thousands and thousands of options and allocations and decisions to be made, and maybe only a small fraction of those actually get to the meat of what you're trying to accomplish or what your needs are. And that's why having an investment manager who actually asks you these harder questions that, we were talking about, helping a client with their personal goals, but sometimes they don't know what their personal goals are. I say to them, well, when do you think you'll retire? And they're like, I don't know. Like, I've never thought about it. I have no idea. Or I want to retire when I'm 45. And you're like, well, you're 36 and you've saved, $50,000. How's that going to work for you? So, an investment advisor is there to kind of push a person along and hold them accountable and help them with those really more difficult nitty-gritty decisions with all of these literally thousands of choices that are available to you.
I think a lot of people don't even realize sometimes that those are choices,
right,
that you can make. Right.
Yeah. Did we talk about, or can we talk about, like, a fundamental difference between a mutual fund and an ETF? Or, I mean, we don't really have to get into the exact technical weeds of it, but just like a quick overview.
Sure.
Either.
Well, I mean, there's trading differences. An ETF trades like a stock, and what that means is that the price of a stock, which of course is a share of a company, I try to remind people all the time, it's not just some digits that are on a computer screen, it's a company that you're buying. And the value of that stock changes moment to moment. And so a person who buys a share of a stock in the morning gets a very different price than somebody who bought it in the afternoon. Mutual funds are not like that. Mutual funds have a closing price, and it's the same for everybody. It doesn't matter when you bought it during the day, you get the same price as everybody else on that day. So that's a big difference. And for people who see themselves as day traders or need to make, I need to sell something this morning because I need to take a loss in it, and then the market jumps again in the afternoon, that does make a difference. Beyond that, there's some tax differences if the account isn't a taxable account. There's also the fundamental difference that's always been explained to me that when you buy an ETF, you're buying shares of the underlying companies, whereas if you buy a mutual fund, you're buying shares of a mutual fund. That sounds the same, but it's not. When you're buying the shares of a mutual fund, it's like buying the wrapper around the candy bar, so to speak. You don't actually get the candy bar. You don't have any rights as a shareholder. You just own pieces of that mutual fund. So David, please tell me if I said any of that wrong.
No, I think you hit the key points. And the more complicated point is each device can be so different. People think of ETFs often as index oriented vehicles.
Mhm.
There are ETFs today that are actively managed. They have active management in the ETF.
Mhm.
There are ETFs that aren't cheap. A lot of times people think of them as cheap. They charge much higher fees.
Mhm.
So, there's a lot of detail under the hood here that I think we've been emphasizing,
Mhm.
and it varies a lot, which means it's hard to generalize beyond a lot of what you already said about
Yeah,
the differences.
and we've used those words a lot again, and I know you've done podcasts and we talk about it all the time, but as a reminder, an index means that you're buying a particular group of companies based on some criteria. And that criteria may or may not have anything to do with the quality of the company you're buying. It may have to do with just the size of the company, and that's what the S&P 500 is, or the Russell 1000, or whatever other index you want to talk about. It has nothing to do with whether or not it's a good company. It may just be a big company or a popular company, which, as we all know, doesn't necessarily mean a good company. And so when we talk about actively managed mutual funds or ETFs, we like to buy through advisors kind of like us, but have much bigger teams and travel budgets. And they go around and they actually visit these companies and plants and look through financials, and they make qualitative or quality-based decisions about a company. Like, yeah, everybody loves it on, Twitter, but what are they actually selling? Those are the kinds of questions that an actively managed fund manager asks.
The quantitative thing, which is the other side of qualitative,
Mhm.
you can find that in mutual funds where a person or a manager is going to use, kind of a model or kind of a formula based on quantitative factors
Mhm.
in deciding, what to buy or sell. Some of the ETFs, when they first started doing more than just tracking a common index, they called it smart beta, so it was like an index,
Mhm.
but they would skew it one way or another. One of the first ones first categories that were done were the ETFs that did dividend weighting. Look at the dividend,
Mhm.
the dollars in dividends to allocate within a group of stocks. And there are many varieties of that today. There are quality factors that are worked into an ETF to skew the index in a different direction
Mhm.
in generally a quantitative way. They generally follow a formula or an index that's formulated that way.
Mhm.
It's another level of complexity, but it means you have to be careful what you're buying. You can get a
Mhm.
concentrated, skewed ETF and think you've got a broad index if you don't look at the definitions in the prospectus, which is very hard to read and sometimes not clear. But knowing what's actually under the hood is getting a little harder.
Mhm.
Yeah, and that's another thing I was going to bring up, is that typically in a mutual fund is typically actively managed, although not always, and that can be opaque. You don't always know what that manager is buying and selling on a day-to-day basis. They'll report those quarterly. On an ETF, you can see what they're doing day to day. It's more transparent in general. There is some crossover between the two. Like, you can buy an S&P 500 index, or you can buy an S&P 500 mutual fund. So it depends on what the product is, but in general, right? So I think we covered a lot of the differences between ETFs and mutual funds. What about individual stocks?
How does that come into play in a
Well, they
portfolio
can
or
be
in general?
they can be great. I think one of the greatest things about individual stocks is that you can buy one and hold it a long time, put it on dividend reinvestment, which doesn't cost you any extra trading fees to speak of, so that when the dividend comes in, instead of you getting any cash, they just buy fractional shares of that stock.
If it gives dividends.
What?
If it pays dividends.
Yeah, if it pays dividends.
Mhm.
But to use them in that way in a brokerage account where you have to be tax efficient, because it's a taxable account, it enables you to buy, hold for a long time, not sell very often, so you don't incur many capital gains. Dividends are tax favored today if they're qualified, and so the dividends build up in that way without a lot of tax consequence. It becomes a pretty good device. You don't get the tax benefits of a Roth IRA,
Mhm.
but you can get the benefits in a brokerage account of using individual stocks in that way. Your problem is diversification and avoiding too much emotion. I know I remember meeting with a prospective client, back some time ago, and he'd worked in the technical field, and therefore everything he bought in individual stocks was a tech stock, you know. And this is leading up to the dot-com bubble, and he had everything in the dot-com bubble that was in the bubble.
Yeah.
And so when it burst, he went to 5%. His account went to 5% of what it used to be, because he was over-concentrated in the things he knew about and liked. So stocks have got their downsides too, in terms of which ones to pick.
Right. Yeah. You want to add anything, Danielle? Or
Well, I think it's a great way for an investor to be. David talked about emotion, but there's also personality in your portfolio. We encourage people to invest in what they believe in, what they enjoy, what they like. Maybe stock A isn't going to make as much as stock B, but you don't really like the company by stock A. You might think that their CEO is a little crazy, or he said some really off-color remarks, or you don't like the product or whatever. And there's no way to say that your choices are always going to beat somebody else's choices. If you're constantly in a horse race with everybody else, you're never going to be satisfied. So it's nice to have a portfolio that's made up of something that you like. I mean, you still have to have diversification. You don't need to invest 100% in tech. We would never recommend that, but it's okay to buy things that are boring, that are just good, healthy companies, and I think some people who buy individual stocks think that their end all goal is to see how much money they can make as quickly as possible. And that's not always a healthy perspective on investing, because we all know that the companies that can make money really, really fast can also lose it really, really fast. And if your timing isn't good, meaning you think you're going to know when to get in and out, that's not most people aren't successful at that. And so there's that sort of, I guess it's kind of non-emotional. It's almost a cocky way of running your portfolio, but that's why we like to say, you have to acknowledge that your favorite pick or choices we make are not always necessarily going to be the most lucrative for whatever period of time. But you can't look at 1 month or 3 months or, even 10 years. You just have to say what makes sense for me right now. And for the, for the long term, do I just like this company? I want to hang on to it forever. I've got a lot of, kind of like you mentioned, that the person who had all tech stocks, there are people who've worked for the same company. It's not as common anymore that somebody's worked for the same company for 30 years. And you look at their 401k as they're getting ready to roll out and retire, and 25% of their portfolio is their company stock. That's a huge risk. And they don't think of it as risky because they're like, well, I know that company, it's a good company. But if that company goes under out of nowhere, which happens, 25% of your portfolio is gone. And if in the case of an individual stock versus a mutual fund, if that company doesn't recover, neither do you.
Yeah.
And so there's nowhere to go.
Yeah. And that's a lot of the value that we can provide as financial advisors, is removing that emotional attachment that people get to certain stocks, right?
Well, and money's emotional, period. I mean, it's just a good idea. I think I spend a lot of my time, I rarely have to talk a client down from a bull market, like, oh, it's never going to go down. It's usually the opposite, right? Like, oh my gosh, it's going to die. Everything's going to be horrible. I mean, think during the last bull market that lasted 10, 12 years, we heard that every 6 months. This is going to be over. This is never going to be like this. And we all made so much money. And usually the opposite is true. The market's in the toilet, and as it does. And a client calls and says, oh, I need to get out and just buy, stay in cash. And we have to have the conversation that when the market is having a hard time, so is cash. It's not obvious. You don't see a ticker for cash. You don't see it going down 8 and 9%, which it did in 2021.
Yeah.
But those are the kinds of things that we have to pay attention to, and just try to keep your head on straight. And, I was even thinking this morning, I wish that I had kept track of every dollar that I had actually contributed to my retirement account, or my employer had contributed for me, because I would really love to know, like, how much in here did I actually put in and earn? And I know that what I have is much larger than that number. But after moving things around, and I've lost track as much as at some point I had that number in my head, and it's gone now. But and almost nobody does. So if you've been investing in a portfolio for 5 years, 10 years, 40 years, you've already made so much more money than you ever put in. And that's the focus. Like, that's your goal, is to keep going forward. You can't just stop. You just have to continue to make those decisions.
Each of these devices, though, they have their place, right? And I like to say, and I think it's true, that a lot of people that are just starting out in investing, investing that first $100,000, getting to it is
Hard work.
it's hard,
Mhm.
and it's discouraging to a lot of people.
Mhm.
But very often, you just keep putting money in it. Don't worry about it. Lends itself in some ways to an ETF index fund, a broadly diversified
Sure.
ETF index fund. Keep it simple. Just keep adding to it. You get up there, you got a few $100,000. You can use individual stocks then because you've got enough room to diversify. And you can always then begin to go, oh, I want to buy ESG companies because I'm interested in environmental and social and governance issues. So I want to go to a mutual fund that does those kind of active changes. So what you may want to buy or what you may be involved in may change different times and where you are in the investment cycle. Same is true as if you're going to draw money out or as you approach retirement. You may want to use different vehicles to meet those purposes.
Yeah. I think that was a really good sum up, actually, what you said there, how to incorporate these 3 different types of equity assets in your portfolio, and when it might make sense to do it is going to be different for everyone. So and I also just wanted to point out really quick, we had a listener question on our last episode all about the kind of taking the emotion out of investing and like just holding on to one investment that maybe you just really researched and you loved 10 years ago, like it's not really serving you well. So go ahead and listen to that. I believe it's episode 29.
Yeah. Knowing what to buy is different than knowing when to sell.
Yes.
It's 2 different approaches.
For sure. All right.
We'll link to that in the show notes,
Yeah.
right? That last episode we discussed that. So unless you guys have any final thoughts.
I thought that was really good when we kicked the table and the screens
Yeah,
were all
sorry
jumping.
about
I'm
that.
sure the people watching.
Oh, I didn't even
saw it.
notice it. I
That was
missed
me.
it.
We're all at the same table.
I
so
was
we had
just
to kick
lost
it,
in thought. I'm just like thinking about what I want to say next.
We're professionals.
Well, we're going to get back to work. Thank you for listening, and find all of our links and resources at connectingthedollars.com, and we'll see you next time.
Bye.
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 That will do it for this episode of Connecting the Dollars. Nothing discussed in this episode should be considered legal, financial, or tax advice. If you like what you heard, please subscribe for more at Apple Podcasts or wherever you get your content. When you do, please give us a rating and a review. To see the links we mentioned in our show, along with other great Propel Financial Advisors content, go to connectingthedollars.com. You can find our past episodes there and subscribe to our newsletter. And if you're still here because you have a general question, you can email us directly at info@connectingthedollars.com. Or, if you're interested in working with us, click the Schedule a Consultation button on our website. Thank you for listening.